Hi, this is Hutch with BankingTruths.com, and today we're going to talk about the dreaded fees inside of an index universal life policy. And if you start reading about IUL online, you'll probably find these pieces that talk about the cost structure of IUL almost like a ticking time bomb, almost like it's a trap that the insurance company is waiting to spring on you. They can't wait for you to get your money in there so they can just exponentially increase these fees so it cannibalizes your cash value and lapses your policy. And although something like that might happen in the most extreme situations, it's hard to imagine a scenario where that can happen when the client's goal is to max fund a policy, meaning put the most amount of premiums into the least amount of death benefit. Their performance would have to be like so vastly different from what was projected, or they'd have to have some kind of extreme scenario where the premium schedule they were hoping to put in was completely different from reality, in which case there's still measures to ratchet down the death benefit. But I digress. Let's talk about what you're seeing on the screen here. And it is an example of a male age 45, preferred health, my age right now, probably about my health. And you can see that we're using death benefit option 2. And what that means is we're starting with an increasing death benefit that will increase in the early years. And then once we're done paying premiums, it'll flatten. And as the cash value converges upon this, so the cash value is going to track along with the policy, and then it'll start to converge upon the death benefit. At some point, it'll hit what's called corridor or the corridor test, and the insurance company will automatically start pushing up your death benefit. Now, a lot of people don't realize, but the fees and charges inside IUL is based on not the total death benefit, but what's called the net amount at risk. So if you use this policy structure, where's my arrow? Then it would be about the same through this period because your cash value, your death benefit is increasing by the size of your cash value. But then you can see it'll start to get smaller as the cash value gets towards the death benefit. And that's really when the fees and charges or the cost per unit of insurance starts increasing. Near retirement age and really post-retirement, like after you retire, is when it starts to get really bad. So we can see here in this insured cost of insurance column that the charges indeed do go up as the client gets older. But then they hit a point right here where you can see it approaches 1,700 and then it starts to go down. So the cost per unit is still going up. So during this time, he's paying for a higher cost of insurance as he goes from a 61-year-old to 62 to 63 to 64. But what's happening is the cash value here is converging upon the death benefit. So he is paying for less units of this insurance. And I think that's a very, very huge point that most people don't understand when they read these hit pieces. So let's just talk about the other fees and charges you'll see if you have a supplemental report like this run on your illustration. One is called the premium expense and tax charge. And a lot of clients don't realize, but the insurance companies do need to pay something called a premium tax for every premium they receive, and they pay it to the state where the policy was issued. Now, it's possible that maybe, because the tax varies depending on the state, that the entire premium expense and tax charge won't go to the state tax. But I liken this, and this is an analogy, this is not exactly 100% true. I liken it to almost like old school money management. So it used to be when you bought mutual funds, it was hard to find any no-load funds. And you could either pay an upfront load, so you could pay an upfront commission and have a lower load inside your mutual funds, or you could pay no load and have higher loads inside your mutual funds. And like I said, this is not apples to apples, but when you think about it, the insurance company is agreeing to manage your money at very favorable terms. And later on, you can see once you're done paying a premium, they're not really collecting anything for that. And all they're collecting here is the cost of insurance. And there's this expense charge that is more expensive during the first 10 years, and this is what we call the acquisition charges for a policy. And after that, you're merely paying for this low policy fee. So it's almost similar to paying more of an upfront load to have the insurance company manage your money in this way. Now, just continuing on the expense charge, what's nice is when you compare this to whole life, oftentimes the expense charges will be comparable, and it's hard to unbundle. There is no charges report inside whole life, but we find that you'll pay something comparable in this expense charge, but it'll usually come out in the first 1, 2, 3 years of the policy, depending on how it's structured. And with Index Universal Life, at least it is spread out or amortized over 10 years, so you have the opportunity to have more money working for you, more money earning interest for you, even though your net cash surrender value might be lower. That's just because of an arbitrary surrender charge that the insurance company is going to put on to make sure they have enough time to recoup their costs for issuing this policy. And on this particular policy, we did not use an enhanced cash value rider where you could waive the surrender or make the surrender a lot closer to the account value. And that's why you're seeing 0. Also, it's worth noting that this particular policy has very favorable chronic illness, critical injury benefits built into it. Not as a rider, it's just built into the underlying policy chassis, so you don't need to pay any charges. Now, what I'm going to do now is I've taken these same fees and charges and loaded it onto a spreadsheet, because I'm sure some of you are thinking like, hey, yeah, these are the good charges, but then it's just going to get horrible like I was reading about. Well, let's take a look. So I've loaded all of this onto a spreadsheet, and I've added some key columns here. So the main column that I've added is, well, the two are total account charges, where we can aggregate all of these. You can see we just used a formula here. And then also the charges as a percentage of the account value. So this would be similar, using the mutual fund analogy again, this would be similar to the NAV, or excuse me, the expense charges as expressed as a percentage of what the asset value is. So when we look at this, and what I did here, we're going to go over this later. The first 5 years are the worst years because you can see not only are you paying the premium load, which eventually vanishes, these higher other expense charges, which eventually vanishes, but also you don't have a lot of account value in there to offset the charges. So it seems egregious. And in a vacuum, when you hear you're going to pay 16%, maybe more, because this is assuming you get some performance the first year, nobody would sign up for that. However, what I want you to see is from year 6 to 10, from year 6 to 10, it becomes a lot more in line with, say, money management. So if you hire a financial planner to manage your money, oftentimes they're going to charge 1 to 1.5% plus whatever the underlying funds are. And so depending on how much those building blocks cost, you might be paying right around the same amount. Notice from year 10 on, let's just look year 10 to year 15, it does go down substantially. And keep in mind, you're still paying this premium load, even though the bulk of these expense charges vanished. There's still a hefty premium load coming out of your new premium dollars coming in. But since you have more of an account value to grow and offset some of those charges, it doesn't seem quite as bad. Notice what happens from year 16 on. Well, wait a second. Now we're talking about what today's no-load index funds might cost anyway. Not to mention, I don't know any index fund that's going to give you a death benefit. They're not going to say, hey, you have $513,000 in our mutual fund. I'll tell you what, if you die, we'll give you $1 million or $800,000 or whatever it is. That's pretty sweet. So if we scroll all the way down, you can see the charges go down, and we're all the way out to age 76, I think, 75. And then it does start to go back up, and you can see as a dollar amount, the charges are pretty nominal and manageable, because again, the cash value is just right up against that death benefit. And it's only until these later years where death is set to occur that you start paying very large dollar amounts. However, oh, and this is the total fees, if we look at it as a percentage of how much money you have in there earning interest, it's pretty nominal. And although you may not need that much death benefit way out here, because I did look at age 90, we can just look together. So we have 4.344 of cash value. If I go back to the illustration, I think we're page 22. So 4.344 of cash value, there's only 4.562 of death benefit. So you're really paying for like $217-ish thousand of death benefit. So again, when you look at it in a vacuum and you say, gosh, $18,000, almost $19,000 is a pretty steep price to pay for death benefit. Well, guess what? There's a really good chance you're going to die at age 90, which is why they're charging you that. Not to mention, remember, if you keep a policy in force, even if you bleed it way down for income, all of the lifetime loans, withdrawals up to basis are all deemed tax-free once any amount of death benefit is paid here. So as a percentage of how much money is in there working for you, it's quite nominal. And if we just look at the average, we're looking at 1.54%. So not very much over the life of the policy. Now, I know some of you are thinking, Hutch, this interest rate you're showing is probably a good one. You're right, it is 7.35, but that is the AG49 rate, which means they look back 65 years and looked at every 25-year rolling period in that 65 years, average that out with this particular carrier's caps and floors, and at the time of this video, whoops, that's not a pen, that's a square, it's 0 to 13%. I just ran it just for the last 45 years since I was born in 1973, and they're telling me I should use 7.78 instead of 7.35, but we can't. We're using 7.35. And then I also ran how low of a cap does it need to be to do a percent below, to have it be 6.35, and it's actually, the cap would need to be 10.2%. If the cap was as low as went from 13 down to 10.2%, then in the last 45 years, it would only earn 6.35%. And let's look at those fees and charges. So if I move over to this tab, if we scroll all the way to the bottom, you can see that the average only went up to 1.59%, not very much. The other thing I want you to notice is remember we paid $18,000 of death benefit at age 90? Well, you're actually paying for less death benefit. Now, it is a higher percentage because we have less cash value, but you're actually propping up less death benefit, which is nice. So again, this is manageable. We've squashed the cap in this scenario, and it's still very, very far from blowing up. I'd like to show one more thing that I think is interesting. I often tell clients that the first 5 years of paying premiums, you should almost liken to just putting in a savings account or just putting it in a mattress. And so if you do that and we just clear the contents and we take this out of the average, the rest of the years, the average for the life of the policy is 0.62%. So all this talk about how expensive index universal life is, or how expensive life insurance is in general, it's really not based on facts. Probably even if you heard it from your financial planner or accountant, they probably just read the same garbage you are. So I would encourage you to test and measure your own numbers and take a look at your own policy and stress test it and see if that is an acceptable cost-benefit relationship. And one last thing, going back to the first 5 years being the worst years and having not a lot of benefit, little or no, we can see here even in the 6.35, you put in 100, at least you have 102 working for you. Even after the fourth year, almost all your 80s working for you, plus you had death benefit. But I talk to clients about how, especially real estate investors or business owners, when you started your business, were you profitable early on? Were you profitable in your first years? And even if they were, what if you factor all your time and blood, sweat, and tears into that? Were you really profitable? Same thing with real estate. You might have to do improvements, paint, curtains, whatever you're doing. And still these real estate investors are doing quite well because they realize what a great long-term asset it is to own. So I'll often ask them, would you do it all over again? And they say yes. So I'd encourage you to not believe all the hype and do your own analysis on this.